Hey everyone, welcome to the course today. This is, I have not done this course before, and I am really excited to do it. And it is, oh, and none of my slides are in order. Hang on one second. I will do this. You'd think I'd done this once before. Okay, here we go. Take two. All right, everybody, hello. This is a session known as Borrowing as a Business. If you are a business owner and you are trying to learn how to borrow in the name of a business, or you are hoping to try to borrow in the name of a business, if with a business idea that maybe that you have, this is for you. This is exactly going to be up your alley. I've had a lot of people express some interest in this, so I don't really know what to expect. I don't know if anybody's going to show up. I've got a few people on here now. I'll give a few, obviously people are going to be coming in a few minutes. But here's what I'm going to do. I've got a lot of material to show you. I'm going to try to be done with this in about an hour. Probably going to take a little bit longer. So I'm going to get right into it. But as Lauren posted already, where are you joining us from? I'd love to know where you're joining us from. What kind of business are you in, or maybe a business idea that you have? I just want to kind of put a couple things out there, just some housekeeping items really quick. Do your very best not to multitask. There's going to be a lot of granular stuff near the end of this session, because we're going to start getting into some of the granular details around how to actually calculate things like EBITDA, things like NOI, net operating income, things like debt service coverage ratio. Those are the sorts of things that are going to get very granular. And I'm going to tell you right now, I'll have to mention a couple different times, there will be a replay. We'll be emailing that replay to everybody. So if you are interested, you are more than welcome to. If you have to hop out, I certainly get it, but just let us know kind of where you're from and what business that you're in, or what business idea that you have for borrowing. So one quick thing that I just want to say this up front is that there are many people who come to me because they're entrepreneurs, because they have business ideas, and they want funding for their business idea. I'm just letting you know this is probably not the forum that I'm not saying that it's going to be worthless for you, but going to a bank when you have a business idea, unless you are already well capitalized, it's probably not going to be the best bet for you. You're probably going to be looking more like an angel investor or someone who's got ideas that can help you, that will also add things to what you need, which is more than just money. When you get an angel investor, you get their entire list of contacts. They will help you build out your lead generation engine. They'll help you with management. They'll help you with leadership. They help you in lots of different ways that banks won't. What I'm going to be talking about today is borrowing from a bank. Now, I'm letting you know I'm putting on my underwriter hat today, and I was an underwriter for a commercial bank and for a commercial loan department for many years. And then I went to, they call the dark side. I went to the other side where I did a lot of compliance type work. So I did a lot of loan review type stuff. I'm just letting you know, like, this type of borrowing is specific to the US. So if you are here you're in Europe, or you're in a different area, I'm just letting you know I am not familiar with those regulations. Banking regulations are different. Lending standards are different. I'm just letting you know this is how we look at it in the US. So unless you're planning on doing that, within the US, in the United States, your experience with this may be different. So I just want to be honest with you. I get a lot of people across the world who log into my sessions, and I just want to make sure that I'm very clear on that up front. So you're from Edinburgh in the UK. Your business is in the US. Okay, perfect. So Diana, it's maybe very relevant for you, especially if you're looking to borrow money from US banks. So this should help you very good. So what kind of business are you in, Diana? If you want to plug that in there. So why borrow? Why would you want to borrow? Well, borrowing, it allows you there's a couple different reasons to borrow, right? You can accelerate growth with your borrowing. Maybe you're outpacing your ability to generate cash. Sometimes just to pay back very high and expensive debt that you have funded out of your own pocket. Maybe you're funding it with credit cards. Maybe you're funding it with personal debt. Maybe you're using a home equity line of credit, and you want to borrow in the name of your business to kind of clear that stuff out. And that way you can clear up your own stuff. Everything ties to the business, and you are in much better shape. And that's a good thing to do. So I certainly understand why people will do it. I just want to make sure that you understand really what it is that we're trying to do here, and why you might want to borrow in the name of a business. And it also keeps things nice and clean. So you're not wondering, did I use that credit card for that account, or for what it was? But realistically, I want you to recognize that first and foremost, bankers are in the business. They're not in the business to loan money. I know that that is really popular. Yes, they're in the business to loan money. Yes, of course, that's obvious, but they are primarily in the business of managing risk. And until they and when you understand that their job is to manage risk, you're like, well, they're in the business of loaning money. I don't know why they want to loan me money. Nah, they can loan. Trust and know they don't have a problem loaning money. That's pretty easy. It's managing risk is really their job. And when they put that 100,000 or $1 million or $5 million out, they need to make sure that they are managing the risk of that money and pricing the loan accordingly. So I'm just letting you know what we're going to get into here, and I'm going to try to not wander too much because there's so much to know. But I'm just going to talk about specifically underwriting. I'm not going to talk about all the other aspects of lending, which is around pricing and all the other areas, because when I say pricing, I'm talking about rate. Many times when you're pricing loans, they are not tied to normal mortgage rates. They're generally not. They're generally tied to what's called the CMTI, the Constant Maturity Treasury Index, where you're looking at what's something called like 300 basis points or 350 basis points over, say, the 5-year treasuries. So when I say 300 basis points, that's 3%. When I say 350 basis points, that's 3.5%. Why don't they say 3.5%? I don't know, because they like to sound like they're fancy, and they are movers and shakers like they do in the bond market pricing. They talk about like in basis points. So I don't know why they do, but that's what they do. So they'll say like 275 basis points over the 5-year treasuries or the 10-year treasuries or something along those lines. So I'm just letting you know, like, that's generally what you can expect. And then of course you just add the 3% to whatever the treasuries are, and then you can kind of figure out the rate. So it's not hard, right? It's not hard to figure out, and they'll usually tell you what the rate is, but they like to be fancy. So just letting you know. That's the language that they speak. All right, so let's get to the agenda for today. First and foremost, I'm going to be talking about the Viper methodology and the framework. I'm not going to get into super granular details on this. I speak about the Viper framework and the other aspects of it, but it is very, very relevant to what we're talking about today, because bankers, again, are in the business of what? Of managing risk. And the better they know your business, the more well thought through that you have of thought through on your business, they're more likely to say yes. So I'm going to give you several things from a top-down perspective on what to look at. And then I'm going to show you how to get a copy of a business plan. I'm going to show you that here in just a hot second on how to do that. But again, try not to multitask. If you want to hop over there real quick and grab the business plan template, you can do that, but just stay plugged in here with me. So after the Viper methodology, we're going to be talking about the 4 core functions of business. Just do a quick primer on that. And then we're going to get into the financial statements. Why are the financial statements important? Financial statements are important because that is what the underwriter is going to ask for. They're not just going to ask specifically for tax returns. Yeah, they're going to ask for, they may ask for K1s. They may ask for Schedule E's, Schedule C's, all of the things. They may ask for bank records. They may ask for bank statements and things like that. But the reality is there's certain things that they're going to be asking for. Financial statements, I can guarantee you, are going to be one of those things they're going to ask for. So I'm going to go through the basics of the financial statements so you know what it is that they're going to ask for. We're going to talk a little bit about underwriting and lending. Not going to get super granular. It's just going to be an overview so you can see the rough view of this. And I'm going to show you how to get a copy of all these templates for free. You don't have to pay a nickel for them. If you do want, though, just letting you know, the more advanced stuff, I can show you how to get to the advanced stuff, which shows you more advanced lending stuff for not a lot of money. It's just a course that I have. There's a free course, and then there's a paid version of the course on the other side of that. So I'm just letting you know that's what I have. It's not a lot of money. I trust and know I am not making a ton of money on that. It's just trying to recover my costs from all the editing and stuff that I had to put together to put that together, or to put that course together. So that's that. And then finally, the success strategies and different resources that you have at the end. So if you want to hop over to strategicboardroom.com, let me get my gigantic dome out of the way here for just a second. If you go to strategicboardroom.com, which is my website, and you go to this page, okay? So if you take a look at the top, you see where that circle is, where it says courses and logins. That's where all the free stuff is, okay? That's where the free and paid courses is. So if you ever buy a course or sign in and get a free course, this is where you will go to sign into these things, okay? Just letting you know. So once you get in there, you're going to scroll down, and you see where it says this free 9-step business plan template. That's free. You just click on that. You don't even have to enter your email. It just pops open, and just download that, and then you can do your thing with that. All right. So that. So let me just go through that one more time, because I know you guys are going to have questions like, what website was that? So go to strategicboardroom.com, go to courses and logins right up there on the top right, and then scroll down until you see free 9-step business plan template. All right. Let's move on. So from there, let's get into the Viper methodology and the actual Viper framework. Everything that I'm going to be talking about here in regards to Viper is written in this book, The Time Wealthy Advantage. If you're international, you'd like a copy of this book, my suggestion is go to Amazon, buy it there. That's probably your best bet. If you are U.S. domestic and you'd like a signed copy, you can go to strategicboardroom.com. On the main page, you can buy it right off the main page if you'd like. So there is that. If I haven't said it before, Diana, you're saying I have a technical service-based business. Okay, very good. By the way, if I haven't said this before, you will be getting a replay of this entire session. So just want to make sure that you are aware of that, because I usually get that question along the way. So from this perspective, there's a business approach that I take. There's a systems side of the business, and there's a psychological side of the business. Let's first talk about the system side, which is the Viper methodology. The Viper framework is an acronym for vision, infrastructure, process, execution, and reporting. And that is the framework of how I construct a business. So the reason, yes, I gave you the business plan. What I'm going to suggest is, don't be scrolling through the business plan right now. It gives you some framework, on how to put a business plan together. And yes, you should answer those questions and have those things well developed for when you go to a banker. You know why? Because they're going to want to know that you've thought these things through, that it's not just verbiage, that you have written pages on, like, you've taken the time to actually write this stuff down. That matters. The reason I'm giving you the Viper framework now is to start to help you develop what things you're going to be thinking about that you're going to put down on the business plan. So when you write this stuff down, wherever it's appropriate, you'll see on the business plan. But that's the thing, like, when you hand that to a loan officer, and they're like, oh, wow, you thought your marketing through, you thought your lead generation through, you thought your sales function through, you've got your operational function dialed in. Oh, and here's a pro forma, right? Wow. Like, you've got all this stuff thought through. Okay. So this is what's going to help you do that. So let's talk about vision. Vision specifically it encompasses two different areas. One is personal vision, one is business vision. I wouldn't have a problem looking at a business plan that had at least a reference to what my personal vision is. Now, personal vision specifically is what you specifically want to go. Where do you want to go? Right, Diana, where do you want to go? Lauren, where do you want to go? And when you start thinking, like, specifically where it is that you want to go, and you start thinking, okay, cool, like, and I'm talking about has nothing to do with income generation whatsoever. Then when you think of the business vision is what delivers the personal vision. Great. How are we going to get there? So when you put your personal vision down, what that does in the personal vision is, let's say for argument's sake, like, part of there's plenty of people who I know, who I work with, like, their business is almost like their ministry, which is great. So what if you were to start to put something like that in terms of an overall vision for your company inside that matches your personal vision? It demonstrates character. And I'm telling you, this matters. It matters a lot, especially when a guy like me, as an underwriter, I'm getting, dozens of these things that are going across my desk every day. Now, generally, we didn't say dozens. I would say, maybe one or two every day. But, we were looking at a dozen per week for sure. This is the sort of stuff that matters. Okay. So when you're looking at the personal vision, where do you want to go? Business vision is how are we going to get there? When I think of the business vision, like, again, many people who never take the time to actually stop and think about their business vision, the business vision in essence becomes their personal vision. And I'm just telling you, like, the danger in creating a business vision without ever even giving any consideration to a personal vision is that you end up creating a life that exists to serve the business. And again, if a banker is in the business of managing risk, and you have hitched your entire wagon, Michelle, to only, like, you exist for the business, well, you have become the single point of failure. And as a banker, if I'm looking at you and I see that you're the kingpin, there's some risk there. Not saying that I won't loan you money, but I'm just saying if you're the person, if everything has to flow through you because you're the main guy, because you've got no systems or processes built out, there's some risk there, right? It's a single point of failure. So I would want to know this stuff. I would want to know what kind of systems and stuff that you've got built out, or at least know what your pot of gold is at the end of the rainbow, from a personal vision perspective. So let's look at personal vision really quick. I like to break this down into like a 100th birthday speech. If you're going to do a personal vision, who would you want to be at your 100th birthday, right? Turn 100. Like, who would you want to be there? What would you say? And then, what would you want others to say after you were done? Like, you're done speaking, they come up to you, they would want you to say something. They're like, oh my gosh, grandpa, grandma, that was amazing, right? I love the part about blah, 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 right? Or even more important is, what would be the message that you'd like them to carry outside the room? Now, I'm just going to be done with this in terms of personal vision right now, because I've got so much to get to with the business side, but don't skimp on that side, right? The personal vision is very, very important. When we're looking at business vision is composed of 3 C's. Okay, 3 C's. So when you're thinking of 3 C's, I want you to think of, sorry, I've got a thing there. I want you to think of core purpose, core values, and client avatar. This is incredibly important. And the reason this is incredibly important is because when you're going to be asking for money, and if you haven't thought these things through, the loan officer is going to be like, well, what business are you actually in? Oh, I'm sorry, I'm in real estate. Well, what do you do in real estate? Oh, I do whatever. That's not giving me nice and warm and fuzzy about what your core purpose is. So, or your core values or client avatar. So let's think about core purpose for a second. When you're thinking about core purpose, you're specifically saying, okay, cool, what business are you in and what problems do you specifically solve? If I'm flipping through a loan proposal and I see the core purpose of the business is really highly specific about what they do and what problems they specifically solve and what geographic market they're in, I'll get to that in a second, and who specifically they're targeting, that's going to mean something to me as an underwriter, versus just wanting to borrow money because I'll just kind of keep it a secret. It's not going to work. It's not going to work for lending institutions. And I went in, just so you know, I was not just an underwriter, I was also a loan review consultant. So I would go back into these small banks, and the bank, they were pretty small. They were anywhere from 300 million to $1 billion in assets. And that's a pretty small bank, actually. It doesn't sound like it's small, but that's small. Anything under, even anything under $1.5 billion or even $2 billion these days is really kind of a small bank. Well, I would go in and I would look at these files and go, what does this business do? Like I'm not even sure how the business makes money. So it's really important that you delineate your core purpose, and that's going to be important especially when you're sitting in front of a loan officer looking for money. So let's talk about core values. Core values is what matters to you about this business, and how would the world be worse off if you're no longer in business? And this starts to delineate around company culture. And company culture is really, really important because the company culture and the company brand are inextricably linked. So the stronger the company culture and the more well-defined the company culture is, it's going to matter. And it's going to demonstrate itself. It's going to show itself up in loan proposals. And it should. Like, you should make a point around that, because a company that has a well-developed brand, or a very well-developed brand, always has a well-defined set of company core values and a solid company culture. And that will mean something. So the last piece here is the client avatar. Who specifically and ideally do you want to serve? And you think about their geographics, their demographics, and their psychographics. This goes to something known as target market or target audience. So the target market specifically is, okay, great. This is pretty straightforward. What geographic location are they in? Like, where are they? Demographic is, who are they, right? Are they married? Are they single? Are they young? Are they old? Are they educated? Are they stupid? Right? Whatever. No, I'm saying it. Well, you can be stupid and educated, but are they educated or not educated, right? Do they have a college degree or just high school or no high school, whatever? I'm just saying, who are they? And then psychographics is how they think, right? And you might be thinking, okay, psychographics, I want you to think of Aaliyah, their attitudes, their lifestyles, their interests, and their aspirations and goals. Think about the different things that would matter to your avatar. And this is important in terms of your lead generation. Not really discussing lead generation now. I actually discussed that in a completely different seminar. But trust and know, when you break them down really, really well, your banker is going to want to know these things. And they're going to want to see this yeah, ideally on either a business plan or some sort of proposal for lending. They're going to want to know. And the reason I'm making such a big deal about this is because here's what happens, especially for credits that are larger. And I say credits meaning like you're asking to extend credit. So if I'm sitting around a loan review table or a loan table, a loan review meeting, um, you know, uh, this is what happens is all these bankers are sitting around a table trying to make decisions about $1 million or 5 million or $10 million credits. And should we be doing this? And the loan officer is basically they're under fire. Like it's a hot seat during that time. So when you're in this loan committee, that's what was exactly happening. And the more well informed that you can make them, it's going to make it easier for the loan committee to say yes. So I just wanted to make sure you're setting your lender, you're setting your banker up for success, not setting them up to fail. You want to give them all this information up front. That's the 3 C's of business vision around core purpose, core values, and client avatar. And that is, like I said, the 2 components of that around personal vision and business vision. Infrastructure is the bones of the business. It's the desks, the chairs, the software, the bones of the business, right? It's all the different systems of the business that, again, the websites and things like this. This is really important, again, that you can delineate this somewhat to your banker in terms of what kind of infrastructure that you have for your business. Why does this matter? Because this all should be in alignment with the vision that you created. And if, let's say, for argument's sake, that part of your loan proposal is for buying and adding to existing infrastructure, right? Maybe you want new computer systems. Maybe you want build out an entirely new wing to add more capacity to your production, right? Whatever it is, it's important that you start to think about this. Now, why does vision come first? Because you're going to be building an infrastructure that's in alignment with that vision, right? So I just want to make sure that you take time to understand that. So when you're looking at the Viper methodology, we talked vision, we talked infrastructure. Now let's talk about process. Process includes 2 different things. It's how you do stuff, right? Process is not that you got to understand process. And process includes both tactical and strategic. When you're looking at tactical process, you're looking at, how you do stuff, your standard operating procedures, checklist items, things like that, day-to-day activities. This is something that you're generally not going to put in any sort of business plan or anything like that, because it's too granular, right? But it's still a really, really good idea to build this stuff out. However, what will be put in now let me just make this quick point here because I just left this in for the sake of that. But as I put that little white box around infrastructure and tactical process, that's where your system for the business lies. That's the system component. All right. So if you're really building out the systems, that's it. It's infrastructure and process. But let's look at the process on the strategic planning side of process. This is really going to be important for business planning, business projections, loan review proposals, or things like that. When you're talking about strategic planning, there's basically 3 P's. There's people, there's purpose, and promotion. The people are the people that you need to help execute this strategic plan. One of the people might be your loan officer. It might be, whoever's helping you do this, right? The other people might be, hey, I need to hire someone who can handle the marketing for me. I might need to buy a completely new CRM, customer resource management software, and that's going to cost, $40,000, right? Whatever it is, these are the people component that you need to start to consider that you're going to actually help execute your strategic plan. That's going to be really important. When you're thinking about the purpose of the strategic plan, that is exactly why you're borrowing the money. So when you go in front of the banker, they're going to want to know what the loan is for. They're going to want to know, and they have a right to know specifically what that money is for. So when you get into the strategic purpose, are you trying to go into a new market? Are you trying to gain market share? Are you trying to, maybe you're trying to vertically integrate into into a market that you're currently in, right? Maybe you're trying to launch a new product or service, whatever. What is the purpose of your strategic plan? That's really critical. And it should also be in alignment with what? Your core purpose of your business, right? The 3 C's of business vision: core purpose, core values, and client avatar. Your strategic purpose should be in alignment with your core purpose. It would be like Starbucks coffee starts selling chainsaws. It doesn't match. It's weird. Like, it's just confusing to everybody. Like, why are we selling chainsaws? That doesn't make any sense, right? So you want to make sure that the purpose, your strategic planning purpose is also in alignment with your core purpose of your business. Because when you start to promote this, promotion is not just letting the world know out there what you're doing. It's also communicating internally to your vendors, to your current employees, to your management, right? Or to whoever is helping you do fulfillment. That promotion piece is not just external, it's internal. So you have to also consider that promotion piece in your strategic planning. So that's people, purpose, and promotion. So let's put the fries in the bag on process. Again, we covered tactical and we covered strategic. Execution, all plans fall apart in their execution. So how you're going to execute on this strategic plan, or however you plan on using this money, is really, really important. Because again, the banker wants to know if you're going to be a good steward of this money, and they want to make sure that they are managing their risk. So how are you going to execute on this strategic plan? So this is a really good quote by General George S. Patton. A good plan violently executed now is better than the perfect plan executed next week. And the reality is most plans fall apart in their execution. That's generally because they have too many priorities. And having too many priorities, unfortunately, has the same effect as having no priorities. That's why I like to establish a daily 5, and it's up to 5 maximum number of things that I'm going to do each day. So again, this is a little bit more granular. But again, these are the activities I'm going to be focusing on in my execution. That's probably something that I would put in my business plan, certainly in my strategic plan, is what are the 5 needle moving activities that I'm going to do each day that's going to move me towards my vision or my strategic plan. So again, these are up to 5 highly specific actions that you can take that'll move the needle towards your vision. And they're not always the same 5. My number is 3. I like doing a daily 3. But 5 tends to be a little bit busier for me, but I don't mind doing that from time to time. But that's important. Finally is the reporting function. And this is where you're going to start to measure both your lead metrics, which is your activities, and your lag metrics, which is the results of those activities. So these are the milestones that you're going to want to see, that your banker is going to want to see from time to time. Now, something I have not put in here, but I'm just going to throw this out there. You may be asked to provide loan covenants from time to time. So there's a loan covenant, which is basically like a rule. Okay. So let's say, for argument's sake, that the bank says, okay, as one of the loan covenants, sometimes they're called restrictive covenants, which means that you have to maintain a liquidity ratio of, say, 1.5 to 1, right? Or a current ratio of 1.5 to 1. You might have to have certain financial statements that have to be done from time to time. Right? You have to provide quarterly financial statements so they can see how things are progressing, right? This is something that you may be required to do as a condition of the loan. And if you don't provide that, you can be in default of the loan. So these are the types of reporting things that you should see. So lead metrics are basically your activities. The lag metrics are the results of those activities. So that's what I use for reporting. So this is the business approach. So we talked about systems. Let's talk about psychology. Systems are important, but systems are only going to get you so far. And there's also the psychological component to it, which is a personal psychology, and you've got business psychology. So we're talking specifically about buying psychology. So the reason why we're going into all this psychology sort of thing is they want to make sure that the lenders know specifically what it is that you're looking at, what they're looking at, or who they're lending money to. That's really, really important, because both from a self-worth, self-managing, limiting belief side, and also from an external component, which is, you've got, and when you're looking at business psychology and organizational psychology, you have external and you have internal. Now, right now, I'm in a PhD program for organizational psychology, because I really do want to understand these two different components of not just external business psychology, but internal business psychology. External is dealing with things like buyers and vendors, and even politics plays a role in business psychology. When you're looking at internal psychology, right, you've got the management and you've got the leadership, because those things are really important. And I'm telling you that how you're going to manage these things in your organization and in your business are really, really important. Okay. So thank you, Diane. I appreciate the the understanding. All right. So the thing is that at the end of the day, the bankers want to feel like you are a good risk. That's the end of the day, because again, they want to make sure that you have thought through things. So let's talk about the 4 core functions. Again, the 4 core functions, This is very straightforward. It's lead generation, sales, operations, and accounting. And your customer's journey in your organization happens in this order. And I'm just telling you now, like, it's really important that you delineate how you get leads in, right? And what your lead flow is. And what kind of leads are you, what kind of marketing are you doing? Are you doing outbound lead generation, inbound lead generation, direct response, networking? All these different things are really, really important to make sure that you're being covered in lots of different areas. There's no single point of failure that all of a sudden 6 months in or 6 years into a 30-year mortgage that they are, or a 25-year mortgage, and they don't generally do 30 so often, but usually 20 or 25-year mortgage, or even a 15-year equipment loan, that you're not going to be upside down. Okay. So they want to make sure that you've thought all through these different functions. Now, and the reason I would say that is also think about that through in terms of infrastructure and process. That's what I mean when I'm talking about the 4 core functions. Let's get into the financial statements. This is going to be a super, super quick, not very granular. I'm going to be going very fast on this because I spend a lot of times on this in the financial literacy class. I don't have the time to get super granular with this right now, but this is what I'm just going to show you. So this is a balance sheet. This is actually excerpted from the Time Wealthy Advantage on page 265. So if you look at this, this is a typical balance sheet. If this is a review for you, please just hang in there because this will matter here in just a hot second. So you're going to see the assets at the top, liabilities at the bottom, equity at the very bottom there. If you're seeing the assets here, this is what the top of the balance sheet looks like. You've got your cash balance at the very top. And again, this could be dollars, it could be pounds, it could be Australian dollars, it could be euro. It's all very much the same thing. This follows what's known as GAAP, which is GAAP, Generally Accepted Accounting Principles. So you're going to have your most liquid funds up at top, your cash balances in your checking account, your accounts receivable, that's the money that people owe you, vehicles, and then real estate. So your least liquid, with their least convertible to cash, is down at the bottom, right? So your total assets here is 417,095. Let's look at the middle section, which is what you owe to others. Your assets are what you own. Your liabilities are what you owe to others. So you're looking at your liabilities, which again, more liquid up top, short-term debt, and longer-term debt down at the bottom. Your credit card balance, right? Accounts payable, what you owe to vendors. Wells Fargo, it might be the loan for your van. Citibank or Barclays or whatever is real estate mortgage. And then you've got your total liabilities, 189, 180. The assets minus the liabilities is what the equity is. Okay. So just keep in mind when you're looking at your total balance sheet there, this is important. And it's important that you give your banker a clean balance sheet. What do I mean by clean balance sheet? You have to look at the balance sheet and know pretty quickly that it's clean, that all of the accounts have been reconciled. Your bank accounts have been reconciled. Everything makes sense. And I can usually tell within like 3 seconds if a balance sheet has not been reconciled. And the reason for that is because, a lot of times I might see a negative number in a liability, like a negative number in like a credit card account. Like they overpaid the credit card like by $20,000. That's impossible, right? Like, explain to me how that happens, right? Well, generally it's not. Generally what that means is they haven't entered in all the charges. They've only entered in the payments. So I can usually tell, and there's other dead giveaways, but I'm just saying, like, these are the sorts of things that I would know as an underwriter. I would look at this. I have an accounting background, my degree is in accounting, and I would look at the financial statements and go, these balance sheets are not, they're not clean, right? Which means that the income statement is also suspect. So when you're looking at your income statement, you're looking at, again, these are broken down into 3 areas, which are revenues, expenses, and net income. Then you're looking at, so let's look at this. Let me get my big giant dome out of the way again. So this is where you're looking at your revenues, which is your sales, your expenses, and then of course your net income down at the bottom. So trust and know your banker is not just looking at the income statement or the P&L only. They are looking also at the balance sheet. So let's look at the top line items. You've got product sales and service sales, right? And you see those are broken down into 2 different areas to equal total sales. It's really important. When you're looking at your expenses, you're looking at raw materials, insurance expense. These are very, very basic income statement, by the way. So I'm just letting you know there's no income statement on the planet that's only going to be like 6 line items, but total expenses there, and of course your revenue minus your expenses equals your net income, and then of course the percentage of sales numbers are off there to the right. So if you're looking at raw materials, that is known as percentage of sales. So you got 29.8% of sales equals your raw material. So I'm just saying it's representative of your total amount of sales. And that's a very important metric to pay attention to, even if just you're looking at it from a business perspective. So that's your income statement. So again, very, very basic. And you might be thinking, well, what does this matter? Well, it matters because the underwriting and lending is really going to make a big difference to your banker and to your underwriter. Now, the underwriter and the lender are not the same person. Sometimes they are, especially for very small community level banks, which is who I like to bank with. But if you have a banker, if you're asking for $3-4 million, depending on the size of the bank, their loan authority, the individual loan authority, there's something known as desk authority, which is they have the desk authority to approve loans up to, say, $500,000 or $1 million. So when they are asking for a line of credit facility or a line of credit or a credit that exceeds that desk authority, that means they have to bring it to a loan committee or they have to bring it to an underwriter who then gives it back to them, and then they have to bring it to a committee or however their bank is set up, right? So they may have to just share that with another set of eyes. And if they do have to share it with another set of eyes, you want to make sure you're setting them up for success. So what are the bankers going to ask for? Generally, if I'm going in, again, I'm going in with all of my stuff already filled out. I've got a loan, I've got a business plan kind of already set up. Even if I have an existing business, I've been in business for almost 20 years in my property management business, and I'm still going to bring a business plan because it's going to show expansion. It's going to show my target audience. It's going to do something different, whatever. I want them to know I have thought this through. That's really important because the less they have to replicate, again, people are a little bit lazy. If you can send them an e-file with all this stuff, so all they have to do is copy and paste, maybe change some words to make it sound like they did it, I'm just letting you know this will be much more favorable for you to get them to say yes. So what are they going to ask for? They're going to ask for the basics. They're going to ask for generally 3 years of tax returns. They're going to ask for personal financial statement. A personal financial statement, I'm going to show you this here in a second. I may not have time because I got cut off there, but the personal financial statement is just going to ask for your personal worth, like what cars do you own, what's your personal house, do you have retirement accounts, your savings, do you have silver buried in your backyard, whatever. That's what it's going to ask for your personal financial statement. That's going to be really important, okay? Because they're going to ask for, cash value of life insurance policies, things like that. They're also going to ask for company financial statements. So even if you're an S corp, partnership, whatever it is, they're going to want to see company financial statements. That again, balance sheet, income statement. That's why I showed you that before. What else are they going to ask for? They may ask for Schedule E's, right? This is all US-based tax return stuff. They may ask for Schedule C's. They may ask for K1s and corporate returns. Like the Schedule E is very typical for people who hold rental properties. Schedule C's are any sole proprietor or single member LLCs. K1s, this is if you have a pass-through entity like a partnership, S corps, or are the beneficiary of an estate or a trust. You're going to have a K1, right? They're also going to they're going to ask for corporate returns, which is the 1120. That's for C corps, and the 1120S, which is for S corps. So that's all stuff they're going to ask for. So if you have that stuff ready and like already in an e-file and already ready to send to them, via email or in a thumb drive, make sure you have it with you, right? That way they don't have, or make sure you have copies ready to hand them when you're meeting with them. Okay. The type of business you're in is going to make a difference in terms of whether they're going to calculate EBITDA or NOI. So EBITDA, and this is going to make a little bit more sense here in a minute, but EBITDA is how they're going to figure and factor your company's cash flow. So EBITDA it's an acronym for earnings before interest, taxes, depreciation, and amortization. Earnings before interest, taxes, depreciation, and amortization. So in other words, what that means is they're going to take the net profit and they're going to add back interest. They're going to add back taxes, specifically income taxes, not property taxes, because property taxes is a part of an operating expense, right? But they're going to add back income taxes. They're going to add back any depreciation. Now, depreciation is for any physical assets, like a building, not real estate, because real estate doesn't depreciate. Any physical assets like vehicles, real estate, anything like that. And then amortization is the depreciation of a non-physical asset, like a loan, right? A loan amortizes over time, or a patent may amortize over time. So if you have like a patent, which like, you got 5 years on the patent, each one will, it'll diminish in value by that over 5 years, right? So that's interest, that is earnings before interest, taxes, depreciation, amortization. That's going to matter. Or NOI. They may look at NOI. So generally what you're going to look at, and this will make more sense here in a minute, like I said, it depends on the type of business that they're looking at, whether they're looking at EBITDA or NOI. As an underwriter, I looked at two different ones. I'm just saying, your guy may look at, or your guy or your gal may look at something a little bit different. And then you're going to be calculating, I know for personal finance, you're looking at debt to income. That's not what they look at all when you're looking at a commercial loan. You're looking at debt service coverage ratio, and that's DSCR. Many people call it a DSCR loan. To me, that was just a commercial loan. All of a sudden, people start calling it a DSCR loan. I'm like, oh, you mean a commercial loan, right? But that's what this is called now all of a sudden. So that's what that is. So let's look at this in terms of the different things. So I'm going to actually kill the share here. And I'm going to share something different. Give me a hot second. Because I want to show you, I'm going to go into this money template. Now this money template right here, let me get myself out of the way here, go all the way down so I can make myself nice and small. Okay, actually, I'm going to take myself completely off the screen. All right, so what I'm going to do is this right here, this template is actually available for free. I can give you this if you're interested in it. I'm just going to show you right here. This is a personal financial statement template, and you can get this for free. Michelle or Lauren is going to share the link here in just a minute where you can get this for free. It's actually free in the entire course. It's the free it's in the free portion of the money and lending finance course, so you don't have to pay anything for it. But this is really important. It's going to ask you for your assets, what you own personally, your debts that you have, and you just basically fill it out and then you sign at the bottom saying this is true and accurate, right? So that's a personal financial statement. Let's look at real estate underwriting first. So I'm just going to show you really quick what this looks like. So this kind of collapses. You see this collapse over here on the left. This is the total revenues that come in. Now, this is for year end. So let's say this was for last year. This is for 2024. So I'm looking at the entire year. Now, keep in mind, I would be asking as an underwriter, I'm asking for several years of these, but so I can see the trend over time. But what these total revenues are going to indicate is that I'm going to see, okay, these are the rents that came in. These are the late fees that came in. I've got laundry income, blah, 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 blah. Okay, these are the total revenues. Now, I am going through this rather quickly because I want to make sure I hit both types of underwriting here. So if I'm buying a business, this is really, really important. Michelle put the free money and finance course link up there already. So if you guys want to get that, you can grab that now. Again, you could go to the strategicboardroom.com under courses and logins, and you can get you can find the free link there as well. But the operating expenses is what they're going to take out. You're going to take out, you've got property taxes, insurance, water, sewer, electric, maintenance, blah, blah, blah. Okay, so your total expenses are $342 to your revenues, which is $680. I think that's $685. So your total NOI, your net operating income, is $323,760. So when I actually do this underwriting, what I'm going to be looking at is I'm going to be trying to calculate this debt service coverage for real estate. Okay, so the debt service coverage is basically my net operating income divided by total debt service. I don't generally do EBITDA for real estate type transactions. I generally use EBITDA for manufacturing type businesses or service-based businesses. If it's specifically related to a real estate transaction, this is what I would do. This is my type of underwriting that I would do, that I was trained to do. So again, your lender might be doing something a little bit different. So I'm going to take the total revenues. What I'm going to do is I've got the property taxes. These are all expenses that I'm going to keep. And I've got my NOI. So I've got my NOI. I'm going to take out a capital expenditure allocation of 5%. That was typically what we did as underwriters. So we're going to take 5% for CapEx. 5%. Oh, it's 5% of rents. So yeah. So I was thinking, why is that? So it's basically, it's 5% of rents is what I would take for a capital expenditure. Then I've got management fees of 10% of rents, which was $66,560. I'm reading this from across the room. So if my numbers are a little off, it's because I cannot see and I'm 53 years old and apparently my eyes are starting to fail me, but that's okay. We're here. So, any adjustments to revenue I might add back in. I'm not going to get super hung up on that, but let's say for argument's sake, there was a revenue item that came in that really was like an extraordinary item. That might be, maybe I sold a vehicle, right? And I counted that as revenue. So I know that's an extraordinary item that's not going to be repeated. So I may just take that out of revenue. So here's my adjusted NOI, and then here's my debt service. So my debt service is going to be calculated based on, and again, this is an annual number. So I want to make sure my annual debt service, yeah, I might be paying my debt service every month, but I'm just going to look at, well, what kind of loan am I going to get? For this, I might get a 20-year loan at, say, a 5-year CMTI plus 250 basis points. And let's say that comes up to 7%. Again, I'm making this up on the fly, but let's say that debt service equals 168,000. That's going to come up with a debt service coverage ratio of 1.3. What does that mean? It's the net income divided by debt service. So that means for every dollar that's coming in for revenue, I'm basically servicing that, or I'm keeping $1.30 to service debt with every dollar that comes in. That's basically what that means. So that's actually good. Generally, anything over 1.25 is pretty good. Okay. You start getting below 1.25. Some banks won't even loan you if it goes below 1.2. So that's what I'm saying. It's a pretty slim margin, but I generally wouldn't even touch a deal unless it's closer to 1.5. That's me personally, but that's it. So over here, you'll see the formulas. I am going to move on just because there's so much more to go with this, because I want to make sure that I'm hitting this piece here about basic underwriting based on a different type of business. So let's say this is a manufacturing type business. I'm going to go ahead and expand this so you can see, like, okay, this is maybe a manufacturing, maybe it's an HVAC type company. This says installation and service. Let's say it's HVAC. You get your total revenues here, which includes installation, service, sales, miscellaneous sales, blah, blah, blah. Okay, so you've got your total revenues here. You've got your expenses, right? Those total expenses equal 2.7 million. Your net income is just shy of 2.2 million. So let's go down in terms of the spreadsheet. Again, now this time we're going to be looking at something known as EBITDA, right? The debt service coverage ratio based on EBITDA. So in this case, what I'm doing, I got my revenues, my total revenues. I'm taking out any administrative. Obviously, I'm looking for, I'm taking out all of the normal expenses, right? But I'm adding back. Basically, what I did is I took out all the expenses except interest, taxes, depreciation, and amortization. Okay, so that's what I did. So I only subtracted out the things that were basically not interest, taxes, depreciation, amortization. Or you can just do it another way, which is basically taking the number and just adding it back in. It's 6 of one, half of the other. So now I've got my total debt service of 2.4 million and my debt service coverage ratio of 1.39. So I'm just letting it. So that's how that works when you're actually calculating it. If it's below 1, that means you're not able to service your debt. So that's not good, right? You don't want to be able to service your debt. So in other words, if you're at 1.25 or above, generally it's a pretty easy no-brainer for a bank to say yes. If you are below that number, that is going to be really hard for them to say yes, because they're going to be like, why would I loan you money not being sure that I can get it back? Stands to reason. All right. So let's go ahead and finish this up today, because I want to make sure that I'm getting you guys out of here on time. Let me stop the share and reshare and share screen. So this is the last piece here. There's just a couple of things I want to share with you here in terms of success strategies and a couple of free things. So Michelle already put up there the free money and finance course. Just to be clear, when you sign up for these things, go to log into them, you'll go to the strategicboardroom.com, scroll down, and when you find the free course, you just click the blue bar. The blue bar is where you log in. That's where if you haven't signed up for it, you go to the right, sign up for it. If you once you get there, then you can just click the blue bar and log in, and you can see it. You get access to that anytime. I'll just leave that there. So one other thing that I want to go ahead and do is I'm gonna show you this course right here. Or this is not a course. It's this is a room. It's a group that if you want to be part of our tribe, this is it. This is the Time Wealthy Advantage room. And just don't be a jerk. If you're a jerk, don't come, because we don't like jerks. So if one of you guys can put that link up there for that, that is the Time Wealthy Advantage Room. And also, just for more courses just like this that are free, totally free seminars, if you like them, come to EventBrite. My suggestion is follow Strategic Boardroom on EventBrite, because if you have other things that come up, it's easier. It gives you a notification right away. So that is that. So are you guys able to copy and paste? Diana, can you, I know, Diana, don't be a joke. Don't be a jerk. Can you, are you able to copy that, Diana, those links? I'm just out of curiosity. I just want to make sure that you can see these links. So there's that to join us on Facebook. And then there is that for that. So just want to make sure that you guys can see if you're able to actually copy those. You're able to copy? Okay, good. I just want to make sure you could copy it. All right, very good. All right, so let me talk really fast about the money and finance course. So this is just a couple things. You're going to get access to all the money templates that are in there, just so you know what you're getting. There's the chart of accounts example, like it's literally a listing of all the different accounts that's in there, and understanding what a chart of accounts is. You'll get a basic balance sheet example. You'll get a basic income statement example. You'll get a balance tracking sheet example. I didn't go into all the nuances of this. This is something I cover in the financial literacy course, or financial literacy webinar. But I also talk about this underwriting example that you just saw. So you can actually go in there, you can mess around with it, personal financial statement that you can download. I walk through the debt service coverage ratio for real estate, the debt service coverage ratio for manufacturing and service-based businesses, and you'll see all of that. There's some videos that are in there as well. So there's basic balance sheet training. There's income statement basics training. There's borrowing as a business. So this kind of gets a little bit more granular in terms of what I covered today. Not super granular, but just kind of gives you a rough idea. And then there's term loans, things about UCC1 filings and things like that. It's very specific to the United States borrowing. So that's the free money and finance course. There is an advanced one, which does cost a few dollars. Again, you get all the same stuff. This is all the same money templates that I just talked about, the chart of accounts example, balance sheet example, income statement example, balance tracking, underwriting templates, personal financial statements, plus all those videos that I just talked to you about. So you get all of this stuff, but you're also going to learn about borrowing as a business. It gets a lot more granular inside the paid course. The advanced income statement and balance sheet examples, how to calculate capital expenditures specifically, and not just coming up with a round 5% number or whatever. How to actually put together accounts receivable aging, how to put together accounts payable aging. This is all stuff that's not like, hey, I want to sign up for an accounting course and it starts teaching you about debits and credits. That's not what you need to know as a business owner. You don't need to know that. What you need to know is this stuff, right? And I know this because I would go to these different things, seeing what people are teaching. I was like, a business owner doesn't need to know debits and credits and what's the general ledger. They don't need that stuff. What they need to know is this stuff. What does it represent? Right? Exactly, Diana. Amen. Can I get an amen? Right? So this is all stuff that's really important. So basic accounting, general ledger stuff, chart of accounts, just giving an overview of what this stuff actually is. But in lesson 9, how credit scores in the United States actually, I got an amen. Thank you. You're playing along. How credit scores actually work. There's actually more than 3 credit scores. Most people don't know that. They really don't have a clue, right? There's a FICO 8, a FICO 9, a FICO 10, and there's all different types of FICO 8s and 9s and 10s. So people don't know this. I'm going to actually do that in the training. Metrics that every business owner must know, how to actually calculate a flash report, different profitability metrics and other advanced metrics that you need to be tracking as a business owner. There's balance sheet metrics, ROI, aging reports. Again, I talk about putting together the flash report, something called a loan constant, and actually how to reduce your debt really quickly using and understanding what's called a loan constant. And it also helps manage your risk really, really well. So all of that. Plus, there's another powerful way, something I refer to as infinite banking, which is tax sheltered and also a fantastic way for you to actually fund your own stuff. That is all $37. So if you like that, just go to the paid course. I don't know if you can put that up or if you've put that up already. Michelle, yep, there it is right there. Thank you, Lauren. So she's got it. If you guys buy it today, what I'll also do is we're going to be reaching out with a replay on this. I will also throw in a 30-minute coaching session with me, but you've got to buy it today. I don't have that any other place. I'm just letting you know if you come back on the replay and you're like, oh, I want it. Sorry, you should have been here. So for the people that are here and the people that buy it today, you get it's $37, and I will also throw in a 30-minute coaching session with me. We can talk about really whatever it is you want. You don't have to talk about financial stuff. We can talk about really whatever it is that you want around lead generation, around sales, around operations, around accounting, really whatever it is. That is everything. Man, I still got this done on time, despite that weird blip in the middle. All right. Thank you, everybody, for sticking in there. I really appreciate you guys. I will piece this together and get the links out to you. Have a great rest of your day. And you guys be safe out there. We'll see you guys next time.